Bonds are the most ignored asset class by beginner investors. They are considered boring safe for retirees. But bonds are neither boring nor passive. They respond to interest rates, inflation, and credit conditions in ways that can dramatically affect the value of your portfolio, whether you hold them or not. And when equity markets crash, bonds frequently rally. That is not a coincidence. Today we are going to understand exactly how bonds work, from the very basics to the strategies that sophisticated investors use every day. A bond is a loan you make to a borrower, a government, a corporation, or a municipality. In exchange for your loan, the borrower agrees to pay you a fixed rate of interest called the coupon at regular intervals, and to return your original principal in full when the bond matures. That is it. A bond is an IOU with a payment schedule. The three most common types, government bonds like us Treasuries, are considered the safest investments on earth because they are backed by the full faith and credit of the U.S. government. Corporate bonds are issued by companies and pay higher interest rates to compensate for greater default risk. Municipal bonds are issued by states and cities, and the interest is often exempt from federal income tax. Three terms define how bonds behave, and you need to understand all three. Yield is the annual return you receive as a percentage of the bond's current price. It is what you earn for lending your money. Price is what the bond currently trades for in the market. This fluctuates constantly, and it moves inversely to yield, which we will get to in a moment. Duration is a measure of interest rate sensitivity. It tells you approximately how much a bond's price will change for every 1% move in interest rates. A bond with a duration of 8 means that if rates rise 1%, the bond's price will fall approximately 8%. The higher the duration, the more sensitive the bond is to rate changes. Here is the most important concept in bond investing, and the one that confuses the most people. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. Always, here is why. You hold a bond that pays 3% per year. The Federal Reserve raises rates. New bonds are now being issued at 5%. Your 3% bond is now less attractive than the new 5% bonds. If you want to sell it, you have to offer it at a discount, a lower price, until the effective yield for a new buyer matches the 5% available elsewhere. The price of your bond falls until the math works out. The reverse is also true. When rates fall, your existing bond paying a higher rate becomes more attractive. Buyers will pay a premium for it, pushing its price up. If you hold a bond to maturity, you always receive your full face value back. The price swings only matter if you need to sell before maturity. Not all bonds carry equal risk, and credit ratings are how the market communicates that risk. U.S. Treasuries are rated the highest, effectively risk-free for most purposes. The yield is lower because the risk is lower. Investment-grade corporate bonds carry ratings of BBB or above from agencies like S&P and Moody's. These are companies with strong balance sheets and reliable earnings. The yield is higher than Treasuries to compensate for the additional, but still modest, risk. High-yield bonds, sometimes called junk bonds, carry ratings below BBB. They offer significantly higher yields, but the default risk is real. Some investors treat them more like equity than fixed income. Municipal bonds offer tax advantages that make them particularly attractive to high-income investors. The effective after-tax yield can exceed that of corporate bonds for someone in a high bracket. Type ES Treasury inflation protected securities. Adjust their principal with the Consumer Price Index. If inflation rises, your principal rises with it, protecting your real return. One of the most effective strategies for managing interest rate risk in a bond portfolio is the bond ladder. Instead of putting all your bond investment into a single maturity date, you spread it across multiple maturities. Say 1 year, 3 years, 5 years, and 10 years. Here is how it helps. If rates rise after you invest, your short-term bonds mature quickly, and you reinvest at the new, higher rates. Your long-term bonds lose some market value, but you are not forced to sell them. If rates fall, your longer-term bonds, locked in at higher rates, become more valuable. Your short-term bonds reinvest at lower rates, but you are protected by the higher-yielding longer rungs. The latter means you are always reinvesting some portion of your portfolio at current rates, whatever they may be. It provides liquidity, predictability, and protection against rate volatility. When should you hold bonds? It depends on where you are in your investing life. In your 20s and 30s, you have decades of compounding ahead of you. Equities historically outperform bonds significantly over long periods. A small bond allocation, perhaps 0 to 20%, makes sense, primarily for psychological stability, not return maximization. In your 40s and 50s, capital preservation starts to matter alongside growth. A common rule of thumb is to hold your age as your bond percentage, 40% bonds at 40 years old, for example. Many modern advisors consider this too conservative, but the direction is right. In your 60s and beyond, volatility is your enemy. A large market crash near or at retirement can permanently damage your income stream if you are selling equities to fund living expenses. At any age, holding some bonds provides portfolio ballast. When equities sold off 34% in 2020, long-term Treasuries rose over 20%. A 60-40 portfolio fell far less than an all-equity portfolio and recovered faster. 4 things to remember. 1. Bonds are loans. You lend money to a government or company. They pay interest and return your principal. Simpler than you think. 2. Price and yield always move in opposite directions. When interest rates rise, existing bond prices fall. When rates fall, bond prices rise. Understanding this prevents a lot of confusion. 3. Duration measures your rate sensitivity. Higher duration means more price movement when rates change, more risk, but more potential reward in a falling rate environment. 4. Bonds reduce portfolio volatility. When stocks crash, bonds often rally. A portfolio with both assets weathers downturns better than a pure equity portfolio and tends to recover more quickly. Bonds are not boring. They are the ballast that keeps your portfolio from capsizing when markets get rough. If this video helped you, please hit like and subscribe. Before you go, Monday's video is different. We're not picking up where we left off. I'll explain everything then. See you Monday.